Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and there are plethora of funds available in the market to invest your hard-earned money. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at to help you navigate through this maze? We have on board Arnab Pandya, founder of Money Edu School, to answer all of your queries today. And in case you want to send us your question, you can WhatsApp your query on 865-797-4571. You can also email us your query on themoneyshow@etnow.tv. All right, so let's move on with our first question, which is from Prithvi. And he wants to invest 30,000 via SIP for 20 years, and he wants to know the fund selection for this long-term strategy. We don't have Prithvi on phone line, although we are trying to get him, but till then, whatever details we have, I don't know, what can he do?
So two things are very clear here. One is the amount which is currently available for investment, which is 30,000, and second is that there is clarity as far as the time period of the investment is concerned. So which is 20 years, which is a pretty long period of time. Now, whenever you look at this kind of long time period, it is very evident that your portfolio needs to be equity oriented, because that is the asset class which will help you in the growth of your wealth. So the suggestion here would be that he can focus on a equity oriented portfolio, and the key word here is the portfolio, because there are a host of options available in terms of the different kinds of mutual funds that can be chosen. So in that sense, a complete bouquet of schemes can be added to the portfolio, and that again will be significant enough, because the amount available for investment is 30,000. So a large and mid cap fund in the form of, say, Canada Robeco Emerging Equity Fund, that would be one of the holdings. The other can be flexi cap fund, where I find the value oriented approach of Parag Parikh flexi cap to be a good way of going about it. Then there can also be a mid cap fund, and where Kotak Emerging Equities is a good consistent performer which follows the buy and hold strategy over a longer period of time, and its stock selection has also been significant. And there is also a small cap fund which can be added in the form of Nippon India Small Cap Fund. And in addition to all these four, Contra Fund, where SBI Contra has been a good performer over a longer period of time, that can be added to this. Now, if you see this mix, you have large, mid, small cap exposure. You have a different kind of strategy in terms of value investing. You also have a contra strategy in place. So this can make for a good portfolio, and over a longer period of time, the funds should be monitored and at regular intervals. And if any changes are required, they can be.
All right, this was for Prithvi. We move on, and Dinesh from New Delhi is online and wants to ask his question. Dinesh, hi, good evening. How are you doing?
I'm fine, thank you.
Thank you so much for sending us your question. You want to invest 10 lakhs in a debt fund, is that right?
That's right.
And that will be for just for a year? You just want to park in money for a year?
See, I'm not very sure. In case I need money, I'll use it after 1 year or maybe after 3 years. I'm not sure. So I want to put it in that way.
Okay. But the choice is a debt fund. You don't even want like a balanced strategy where you can have a mix of equity and debt.
I'm already invested a lot in equities and other funds.
Okay.
So it's purely for debt, yeah.
Sure. You also mentioned that 40% of your investment is already in equity funds, and so I'm guessing that what you're really looking at is just keeping your money safe for the time horizon of 1 to 3 years. So a great time to invest in debt funds, Arnab, and the amount that he wants to put in is 10 lakhs. So that should be done in what type of category in a debt mutual fund?
So the first thing is that the time horizon is up to a year and maybe slightly longer. So in that sense, a debt fund is the right choice for this kind of time horizon. And also looking at the general overall economic situation, a debt fund would be suitable. Now the question is, what category of debt fund would be suitable for this? And according to me, looking at the entire situation, a short-term debt fund is a good option, where you can ensure that there is adequate safety of the amount which is invested. Plus, there is a scope for earning also, since the time period is slightly longer, and there is the benefit of liquidity which is also there whenever is required. So a short-term debt fund, according to me, would be a good choice, and either the short-term debt fund of HDFC or ICICI mutual fund, either of them can be chosen, and the amount can be invested immediately because the amount can start earning immediately once it is invested. And overall, considering also that the portfolio has equity, the age of the investor, all those things, the short-term debt fund would be a suitable option at this stage.
All right, Dinesh, is there anything else you want to ask?
Yeah, I
Sure.
want to ask, like, how much return can I expect in this 1 year period?
Sure.
Because I have had bad experience about short-term debt funds. So last about 2 years, the returns are only about 5%.
But now the scenarios have changed. You know, you are in the rising interest rate scenario. So how does that benefit debt mutual fund investors, Arnav?
So one thing you have to understand, that whenever you are looking at the shorter end of the debt fund uh, maturity scale, the focus is not on getting the highest rate of return, because if you want a higher rate of return, normally you play the duration, so you get into slightly longer term funds. But if you look at the past couple of years, obviously because of the rising interest rates, you will find that these funds have been affected and you will not see very great kind of returns. Going ahead, the returns should be slightly better than what you have seen over the past year and a half, because of two factors. See, one is that if interest rates start falling, then obviously the returns will get a boost. But there is no surety in terms of when this can happen. It is, I mean, we are assuming that we are near the peak of the interest rate hike cycle, but it could be quite some time before the rates stabilize and then they start falling. So the stabilization period can run into several months. So my saying is that in this kind of situation, one should not expect too high of returns, but even a 5% or slightly higher return is a good enough thing, because the focus for you is not to lose money and to get something more, which is more than what you would earn in, say, a fixed deposit for a similar maturity time period, plus you get the flexibility.
Where exactly should one be parking in money for to get the benefit of rising interest rates?
So if you want, you see, if the rates are rising, then what is going to happen is that bond prices are falling and the net asset value of long-term debt fund will take a bigger hit. So if the rates are rising, you are better off in very short maturity funds, where it is the liquidity position plus the interest rates or earnings yields on very short-term instruments which are at play. The moment the cycle turns and you have a falling interest rate, that is when you should be into longer term debt mutual funds, because that is where the gains will be the highest. Now, uh, uh, the question is that many investors would not know when exactly the rates will turn or when there are changes in the debt market. For such investors, there is also a category which is known as dynamic bond funds. Now, here the fund manager takes a call on whether you should remain in short term debt or move on to longer term debt, when to move, all those things. So, if that is a question, then the dynamic bond category is a better option, because the fund manager is deciding and one doesn't have to move their funds around, because there, I mean, an investor might not get it right because of the complexities involved in the debt market.
All right, Dinesh, hope it answers your question. But we move on to our topic of discussion today, which is creating a vacation fund. So this year, the Indian Meteorological Department has predicted a harsh summer. Now, if you are someone who is looking to get away from the heat and travel, then this segment is for you. We will tell you the best way to plan and make your vacation fund. So, Arnav, what should be the strategy to make a vacation fund for yourself? Obviously, summer holidays, if one wants to plan for it, it might be a very short call, but can this be done?
No, so any holiday that you are looking at, one needs a vacation fund. Because what is the option if you don't have a vacation fund? Then you have to spend, and then you have to either make the money good. If you have spent it on a credit card, pay the credit card amount by the due date, or you need to have that much liquidity when the payment has to be made. So as compared to this, if you are making a vacation fund, then the good thing is that slowly you can build up the fund, and you can tailor make it to your next vacation. So one should not consider a vacation fund actually as a one time investment. It can actually be a continuing fund where even after one vacation is over, I mean, you can plan for the next one, and that will keep the enthusiasm high, because it's very essential that the planning is done slightly earlier. Now, if you are just a few weeks away, then this kind of vacation fund, trying to create one would be slightly difficult, in the sense that you need to have the amounts which you're going to spend immediately. But the idea is that depending on your destination, you can start putting away money for it. For example, I mean, if you are going to say some place in Asia, which could be Singapore, Dubai, Thailand, or even Jakarta, Bali. Now, all these places will require slightly lesser expense as compared to say a trip to Europe, or even if you are say going to the US, then that will be an even bigger expense. So shorter term trips, if you have slightly lesser time period, you can start putting away money. But if you have a long trip which is to the US or Europe, that is going to require a significant large amount, and that is going to determine you will have to start slightly earlier and start putting away money seriously, so that you have the amounts available when you want them.
A very important part of planning, because one really doesn't want to keep taking loans for these kind of getaways. But is it important to first have your place of destination fixed and then you start accumulating money for this particular goal, or you just make a fund and regularly with proper discipline just keep putting money in that particular fund for this goal?
So either of the approaches can be adopted. The only thing is that if you have a destination in mind, it makes your saving easier, in the sense that you know how much you need to put aside, because you will have done some budgeting in terms of what is the kind of expenses that you and your family are going to make. So that is one thing. The other thing is that if you have a destination in front of you, that is also a motivating factor, because otherwise just keeping away money aside might not lead to the kind of savings that you could potentially do. So having a destination is a good thing, because it helps in controlling the overall amounts which you are going to accumulate. Otherwise, what can also happen is that if, for example, you decide on a destination late, then and that amount which you require is far more than what you have been setting aside, then you are actually back to where you started off from, where ultimately, I mean, you will have to borrow some amounts to make for the shortfall, and which is precisely what you don't want to do. These kind of expenses, it's better off if you start a bit early, go a bit later, even that is fine, as long as you don't get burdened with a debt at the end of the process.
How should one keep the international vacation in mind, in terms of currency fluctuation and planning on those terms?
So this, whenever it's an international vacation, one thing is very certain, that you have an added element in play. So, and this is currency fluctuations, because what happens is that, see, every expense is not going to be made on a single day. For example, the first process comes with the visa, if it's a place where you need a visa. So at that point, one part of the expense comes into play, because you have to pay the visa fees and get all the things ready. At the same time, if it's say a destination like Europe, where they ask for tickets, hotel bookings right at the time of the visa, then you need to have the tickets booked also at that point of time. So that is another expense which comes into play. Now, in as far as hotels are concerned, one can also plan in such a way that you make the payments at the time of either check-in or check-out. So you pay when you reach the destination. And this is where the currency fluctuation comes in for a foreign expense, because what is going to happen is that you might be booking or you might be planning 2-3 months earlier. Now, in the interim period, if there is a currency movement against the rupee, then you will have to actually shell out far more than what you had bargained for. So this is exactly the part where you need to factor in more when you are planning. And the other thing is also that even at this point of time, when you are making the expense, you will also be spending money when you are abroad. So that will also require a foreign currency element, which you have to plan very carefully in terms of how you are going to do it. Because if you are going to say make those spends on a credit card, then you also have to factor in that there will be a markup fee which will be levied on the card. If you are using foreign currency in cash, then it depends on when you are actually getting the cash, or rather converting rupees into the foreign currency and getting cash. And then, because the moment you do that, your cost on that amount is locked in. So that becomes a very crucial factor as far as the foreign currency is concerned. And if you think that the rupee is
Right.
going to depreciate going ahead, you need to also ensure that too many expenses are not left for later.
All right, so that is the planning for your vacation fund. But then we have Sudhir Malhotra from New Delhi online with us. Hi, good evening, sir. How are you doing?
I'm good, Kavita. How are you?
I'm doing good, sir. Thank you so much for sending us your query. Okay, so you want to invest in a debt fund for 3 years?
Yeah, okay. So I'll just tell you briefly. The choice is between investing in an FD, which, takes up maybe 20% income tax versus a debt fund. So I'm looking for a debt fund investment which can give me a return of at least 7.5% over 3 to 4 years.
All right. Is this a part of your retirement fund?
No, this is a part of our savings.
Okay. All right. So no regular income needed, right, from here?
No, not really.
All right. Arnav?
So the best solution for this thing is to actually at this present moment go in for a target maturity fund, which matures after a period of 3 years. Maybe you won't get an exact duration of 3 years, but a target maturity fund which matures after 3 years. So which matures after say April 2026. Now, there are two benefits to this. One is that if you are going for this kind of fund, you have a very good idea of what kind of return you are going to get, because the fund itself invests in instruments which mature along with the fund. So you have a general idea of what kind of rates are prevailing at the moment and what is the kind of earnings that will come. The second part is that you will actually get a very good benefit as far as the tax aspect is concerned. And March end is actually a very good part, because what will happen is that even though you just hold the fund for say 3 years, 1 month, or 3 years, 2 months,
Right.
you will actually get indexation benefits of 4 years. So that 4-year indexation benefit will take away a very huge chunk of your earnings, and the tax impact will be very low.
Right.
Because investing now in March and getting out after 3 years in April ensures that there is indexation for
Right.
4 years available to you.
Right, right. All right, so all the best with the investment. And on that note, thank you so much, Anna, for being on the show and helping our viewers with their financial goals today.